Good afternoon, everyone. Welcome to Hands On. I will let everyone connected to audio. I will wait for a little bit, a couple of seconds while everyone gets settled in and can hear us and can see us and all that. So I will just wait for one more minute and we'll just get started. There you go. I think people are still getting settled. I see it. That's awesome. All right. So welcome. My name is Camila from the Innovation Cluster. For those of you that aren't familiar with the Innovation Cluster, we are a non-for-profit organization that supports do so by offering advisory services, access to partners, and workshops such as this one. We encourage you to apply if you have an innovative idea or start apply at the innovationcluster.ca. Today's session will be recorded, so you will have access to the workshop at a later date. And again, welcome to Hands On. This is all about cash flow, last Hands On of the year. We're very excited with our special guest, Kim Freeburn. Kim is the president of Strategy Corporation and the regional manager for the CFO Center. With over 25 years of large corporate CFO success, Kim uses her experience to help a small and mid-sized owner manage businesses, think big, and take the next steps in their journey. A collaborative strategist, Kim believes relationships matter, change is necessary, and everything is possible with the right business partnerships. Simple strategic steps taken at the right time will enhance the value of your business. Kim brings a holistic approach to adding value to her clients. After all, it's not always about the numbers. As a certified executive coach, Kim believes mindset matters and accountability is crucial for owners to reach their financial goals. So welcome, Kim. Thank you so much for joining us today on our Hands On, and over to you.
All right. Well, thank you, Camilla, for the lovely introduction. And it's a pleasure to spend the next hour with all of you today. Very appreciative of the time that you're investing in your own knowledge and in particular in moving your businesses forward. I do see a few familiar names out there. So hello again for some of you that I've met previously. We're going to be spending some time talking about why cash flow is one of the most important factors in a business and to business founders, and really how to understand the importance of it, but understand how to read the numbers and how to prepare numbers from a cash flow perspective. I'm going to share with you how to avoid some common pitfalls when it comes to managing your cash flow. And then also, what are some of the best practices in bringing forward a strong cash flow projection and result for your company? I do want to start with, what is cash flow? And, cash flow is, at its very core, is how much money you have coming in and how much money you have going out. It really, though, is one of the most important reasons that a business either fails or a business succeeds. You need money to run the business. So the ability to create cash flow from your business activities is very important for your success and for your journey going forward. The ability to generate that cash flow and optimize its use can have great impact on how quickly you can grow and where your business is going to go in the future. We always refer to cash flow in terms of positive or negative. So a positive cash flow, quite simply, is where you have more money coming in than you have going out. And a negative cash flow is you have more money going out than you have coming in. And I know that we all know what that one feels like, either personally or from a business perspective. And certainly the month of December, when people are shopping and taking care of personal expenses, we all use that credit card thing. And typically what we find is that the cash flow in January sometimes exceeds what we're actually bringing in. that's a great way to explain to you what cash flow actually is. So I want to give you a visual of what it looks like from a cash flow perspective when you have the positive and negative. So this is a quick cash flow picture. On the vertical axis, you see dollars. On the bottom, horizontally, you see time. So this is actually an example of cash flow within a company over the course of 12 months. The blue line is the cash that comes in, and cash can vary month to month, week to week, and it does with almost every business. It's not necessarily a stable element of business. So cash coming in can happen at any time, and it varies. Cash going out within a business can also vary. However, sometimes it is a little bit more stable. You have fixed expenses, you have salary, you have payroll. In this particular case, the cash leaving the business is in the orange line. The negative cash flow happens when the orange line is higher than the blue line, and that can occur at different points throughout a year. It can also happen that you have positive cash flow at different points within the year. And so one of the pitfalls, I'll say, that we get into is, historically, we may look at our year-end financial statements and say, well, at the end of the year, I made money. The reality is, though, over the course of 12 months, you can have a lot of different things happening. You can have instances where you're shy on cash, where you have to pay out more than you have coming in. Call those little pinch points throughout the year. So there really is, when it comes to cash flow, the devil's in the details. It's not taking a look at it at one point in time. It's really understanding the life of cash flow throughout your year. In this particular example of this company, at the end of the year, the cash flow was actually positive. They were $15,700 ahead of where they were at the beginning of the year. But you can see that there were times, particularly in January, in month 1, in May, month 5, and in September, in month 9, that they had some challenges and some issues where they were paying out more than they were receiving. So cash flow is all about the details and really taking a look at what happens over a period of time. The kinds of cash flow that a business has can vary. Typically, cash in is revenue driven, and it can come in terms of cash itself. It might come in terms of credit, also called trade accounts receivable, where a client will pay you every 30 days. Those are typical kinds of revenue transactions to bring money into your business. You also have the opportunity to bring money into a business through a bank loan. And quite often businesses will use a line of credit. Bank loans, things like investor funding, where you have investors provide funds into a business to get it to start. Perhaps you might even have a sale of an asset. If you have property in your business that you sell. Cash in or funds in can come from just a variety of different ways. And if you're currently running your business and you've been running it through COVID, then perhaps government grants and government funds have been other types of cash into your business over the last 18 months or so. And we've certainly seen an increase in that. And what that can do to help keep a business floating and help keep a business operating over time has been a tremendous benefit for some of the struggling smaller businesses that we have. In terms of cash out, we're all familiar with this. We pay the rent, we pay our suppliers and buy inventory, we pay all of our employees and remit our sales. Don't forget that loan repayments to our banking partners is also a really important cash out. And some of these are things that have to be done in order to maintain a strong credit standing. So loan repayments, loan interest, and just general operating expenses are your typical cash out types of transactions. I also want to highlight, before we get into some more best practices and how you put a cash flow together, is that cash and profit are not the same things. People determine that at the end of the year, perhaps their profit is positive or negative. Maybe they lost money, but that doesn't necessarily mean that their cash is positive or negative. Accounting financial statements and profit and loss statements can be impacted by what we call non-cash transactions. And those are simply accounting entries that are governed by GAAP and rules of accounting. So don't confuse the two in terms of your profit and loss statement and your cash flow. They are really two different things. Your profit and loss is accounting for your revenue and expenses for a period of time. Your cash flow, I like to think of it as a living, breathing type of activity that happens within the business. It's not a snapshot in time, okay? The key with cash flow is consistency. Optimally, that's what you want to achieve, is that you consistently have a positive cash flow. If you were to look at the graph here that I have on the right-hand side, is this company in particular had a loss, an accounting loss on the year of 14,800, but in fact their cash flow was positive for the year. And all that simply means is that they ended up with more cash at the end of the year than they had at the beginning of the year. And you can see in this particular company's instance is that there are certain months of the year where the cash was positive, but it was really generally fairly low. In April, in period 4, it was positive. Later into period 8, it was positive. But for the most of those months of the year, this company operated in a negative cash flow, meaning they paid out more than what they received. What saved this company at the end of the year and created a positive cash flow was a very high inflow of cash in periods 11 and 12. And you can see by that pink line in periods 11 and 12 that they had a big cash infusion. Now, you might say, what kind of a business is this, and how can that happen? Maybe a sale of an asset, a large transaction can occur. In businesses where you also have contingencies, or you may have long projects that will occur, where you have large cash amounts coming in at the end of a project. Construction and consulting might be two examples of this. So that type of situation can have a real impact on what the cash flow is on a business throughout each month and throughout the year. All right, so let's get into, I'm going to try and slow this down a little bit. Let's get into talking about how to put together a very simple cash flow and where to start. My best, the easiest and simplest place to start is use an Excel spreadsheet. It's a fairly easy task to learn Excel if you're not comfortable. Excel is very versatile. You can add and delete and change and modify and put in formulas to add things up. So an Excel spreadsheet really is the simplest way to start with a cash flow template. There are lots of templates out there. Certainly the innovation cluster themselves, they have templates that they can share with anyone if you were to ask. I like to also, when I'm starting a template for cash flow, is I like to set it up on a weekly basis across the top. Now, that may be very detailed for some businesses, but I'll explain the reason why I like to do that. Cash flow month to month can look very stable. 1 month may, if you look at it on a monthly basis, may look very similar to other months. However, cash flow week to week for any of you who are in business for yourself or looking to be in business for yourself, cash flow week to week can vary significantly. And the things that impact cash flow on a weekly basis may be, when is the HST due? When is the payroll due, and when is the rent due? So those three activities within a business, those three expenses, can occur at different times of the month. And that can change whether you have cash available that week to pay that big expense or whether you don't. So in setting up a cash flow, I always encourage companies to look at it and start it on a weekly cash flow basis until they're used to what the cadence of cash coming in and out is on a weekly basis. And then slowly build that into a monthly type of template. So that's the reason for knowing what happens within the week. I'll say, the third week of the month can be challenging because sometimes government payroll taxes are due in that particular week. So understanding the due dates of those big things are really important. How I like to set up my templates is on the left-hand side, start with your revenues, or what I call the cash in. And in this particular case, I like to see that cash broken out by the types of revenue that I receive, because it tells me what cash coming in is stable and what happens here and there that I might not be able to rely on. So over here on type A in the first line, it says I'm going to receive type A sales. And if this was, let's say we're talking about a beer company, and they have 3 different types of beverages that they sell. Then type A would be their premier beer. They sell a lot of it, and it's what they're known for. So our beer that we receive, maybe in week 1, we're starting the business, we didn't have any coming in. But in week 2, we received $5,000 worth, and week 3, 5,000, and week 4, 4,000. So that's a fairly consistent way to look at the cash coming in. I've assumed in this particular case that these are probably cash sales as an example. The second line, if you have a secondary product that you're selling, maybe instead of beer, this product is cider. And maybe you have a particular client that only takes a cider order once a month, and they do it in week 3. So that's showing the diversity of the revenue and the cash flow coming in. But breaking it down by the types of revenue can really give you some further insights long term. Type C would be perhaps a third product line. Other types of cash coming in would also be loans or investor monies. So in this particular case, this company received $10,000 in week 1 of their business. And so that's shown as cash in for that business. Moving further down into operating expenses, I encourage people to use as much detail in this area as possible. I've seen cash flows where they have like credit card payments and they don't really know, it's just, $5,000. They don't really know what is in that amount. I encourage you, if you have a line like that and you have credit card payments, break those down into detail. Look at your credit card statement and determine how much of it was meals and entertainment, how much of it was product purchases or office expense. Break it down into detail so you could explain what you're spending your money on. With cash flow and particularly with communicating back to investors or back to your banking partners, it's important that you have an understanding of where the money goes at the end of the month and what you've spent it on. So managing the details of your operating expense and putting as many line item details in there that makes sense for you is really important to having the right kinds of information to make good decisions. In this particular case, the first cash out expense that we have is the purchase of inventory. So with most businesses, there's some kind of an inventory or some kind of a service that's being provided. In this particular case, they needed to buy that inventory up front in order to turn it around, produce it, and sell a product at the end. So those tend to be more lump sum purchases. In the first week as well, they had to buy some equipment, so computers and equipment, that type of thing. On a financial statement, that equipment's going to show up as a fixed asset. It's not an expense per se, but it is on the cash flow as a cash outlay. So be careful when you're preparing this expense piece of your cash flow statement that it really represents outlays of cash, not necessarily what we classify as an expense for accounting purposes. So inventory would be one, and equipment and computers and fixed assets and those types of things would be the second. In this particular case, employee salaries paid. Don't forget to put the benefits on that. I see lots of cash flow statements where people have just put the salary line itself, but benefits, at least in Ontario and in Canada, they could be anywhere from 11 to 15, 16%, depending on how much extra benefits are provided to employees. And when I say benefits, I'm including federal government taxes in that. So CPP, EHT, employment insurance, WSIB in Ontario, those types of expenses is what I'm including. So don't forget those. Owner salaries, I only show that once in the month, and we're going to come back to that when we look at the monthly cash flow following this. Employee benefits, interestingly enough, I haven't put the employee benefits on a weekly basis. I've put the employee benefits when I actually had to pay them, which in this particular case was week 4. So keep that in mind. The expense may be incurred in a particular time, but the actual payment of that expense is something different. So this is to record when the payments take place, your cash flow. Operating expenses, bank charges, those usually are incurred either at the very end of the month or the very beginning of the month. And then the visa payment, which I highlighted previously at the bottom, is a lump sum payment. Again, I recommend you break that down into realistic amount of detail so that it gives you some insights on what you're spending on your credit card payments. In this particular case, we started the week with $2,000 of cash on hand, and usually that's founder money, owner founder money. We brought in $10,500 at the beginning or throughout the week, but we paid out $13,100 for the week. And so what we had in this week was a negative cash flow of $2,600. And we actually ended up this week in week 1 with less cash than we started. In other words, we were in a negative. That's a problem, because if we don't have the cash to pay, we can't move forward. So what's needed in this particular case, and this is why a cash flow projection or a forward looking, is we need to make some adjustments in week 1 already so that we can get that back into a positive position. What I would recommend in this case is that maybe we move some of these payments out into week 2. So, but in this particular case, we had a negative for the week. We then carry, you see the blue arrow at the bottom in the middle of your screen at the bottom, you carry the week ending balance over into the starting balance of your next week. And that's how your cash flow works. The ending balance becomes your beginning balance next week and what you started with. So in week 2, we started with a deficit of cash of $600, but we had really good positive cash because we sold all that beer in week 2. So we had $4,450 come in, and we ended up at the end of week 2 with $3,850. So we were in a much better position. In week 3, again, you carry forward the ending balance from week 2, and then you go through the same process of tracking what your cash in and your cash out is. And you end up in week 3 with a lot more cash than you had even in week 2. Now in week 4, because you had to replenish the inventory, you had a big payment again for that. And so it's possible to then have another week of negative cash flow of $4,250. And so your cash at the end of that week is down significantly, but it's still in a positive. You still have $3,550 at the end of week 4. And that actually is a positive for the whole month. You started with 2,000, you ended with 3,550, and you managed to have positive cash flow for the month, even though you had some negative cash flow moments throughout that month. So this gives you certainly some insights into what's happening in your business on a monthly basis. Now, as we move over into what a month to month cash flow looks like, and I recommend you prepare it. Your weekly becomes your monthly, and then you forecast out at least 12 months. Certainly when we're looking at startup companies, we're looking at cash flow projections that are 3 years. 3 years is a really important time to be able to look at what's happening with a business and how it's growing. But what you do in this particular case is you forecast out what these numbers are based on the weekly history and experience that you have. And so we come into week 5, we have some positive cash of 3,550. Everything looks pretty good. Well, maybe it's time to take some salary out, because as an owner, you're not doing this for free. You're hoping that you'll actually have some money to be able to share with yourself at some point. And determining when that is depends on your cash flow. What you want to avoid is situations where you're taking money out for yourself, and then that creates a cash crunch or a cash pinch on the company. So you want to be able to plan forward on when you'll be able to take money out as an owner, so that you can still maintain a really healthy cash flow for the business itself. In this particular case, I want to highlight here in the middle of the screen the red number, that's $3,000. So in month 2 in this company, the owner decided they were going to take a draw or a salary of $3,000. What that created was a negative cash flow for the month by them taking that extra expense in that month. So they decided, because they didn't want to get into a cash crunch, the next month, you see that little that highlighted cell in the middle of the screen under month 3, no cash to the owner in month 3. And that's a real benefit of having control and having insights into your cash flow, is you can make those decisions in advance and know what's coming and know how things are happening, so that you can plan not only when to take money, but when you might have to add a little bit of money back into the business to help it stay afloat. Pay attention to when you're investing, is when, as you're looking forward in your cash flow, when would be a good time for you to buy or reinvest in the business? Maybe you want to buy computers. Maybe you want to expand your office, do some renovations. Maybe you want to invest in some more types of machinery and equipment if you're in a manufacturing environment. So looking out into this spreadsheet, what really makes sense for them is that in month 7, they have a big sale of their type B of $10,000. And so they have this big sale happen. They have a little bit more cash in that month. Maybe that then is the month to invest back into the business. I always recommend people wait until the cash comes in before they make the investment out. Unless you have really strong financing and you have really solid, predictable, consistent cash flow, that you take a more conservative approach in managing your overall cash flow. That's really important. So don't borrow on your future. Try and establish a strong, consistent cash flow before you invest in some of those things that maybe you can put off for a little while longer. Naturally, there will be expenses that you'll have or purchases you'll need to make that you can't wait for the money to come, because those things will be used and required in order to generate the revenue that will then give you the cash flow. So lines of credit, maybe capital infusion from an investor, a loan from a bank, or maybe the owner putting in some more cash can be really helpful in those situations. And so you see there in month 7, when you have a little extra cash, maybe that's time to invest back in, but really being careful to manage that accordingly. I'm going to pause there because I've been talking. And just Camilla, I know that you're there. I want to make sure that if there are questions and things, I don't know if we mentioned this at the very beginning. So if you do have questions, please let Camilla know. She's sort of monitoring, and we'll have time at the end for questions for everyone, because I know that I am throwing a fair bit at you, and I'm doing it at a fairly fast pace here.
Definitely, don't worry about it. I'm monitoring. There's no questions so far, so you can. Fine. Thank you.
All right. Something else I want to make sure is that you do this on a timely basis. I can tell you it can be really challenging for people that aren't numbers oriented to put all of this together and to try and look at a whole year at once. So break it down into small pieces and do it every week. The benefit of doing it weekly is there's not a lot of activity to be able to enter, and you can do it with a fairly short investment in time. When you have to go back through a whole month of transactions, it can take a long time. And that is what we call working in the business and not working on the business. So be very careful that you're doing this really timely, and that you don't save it all up, because it can really be a drain on your time and resources as a founder, as someone who's growing the business, to spend time heads down doing data entry and analytics when you could have probably had that information much more timely. So break it down into small pieces and do yourself a favor. It will save you time in the long run to be timely with this tracking. And it's not always that much fun. So if you have a bookkeeper, this is something your bookkeeper can keep up to date on a weekly basis fairly easily within your business.
There's a question, Kim, actually.
Yeah.
So if we aren't borrowing to grow, how do we continue to offer new ideas, services, products in year 1, 2, before we get that reliable, steady cash flow?
Well, the investor, having an investor or having some startup funds is really important with a startup company, because you're usually not at the point where you have repeatable types of sales. So having an investor, having a good, strong banking relationship can help. There are banks who support more readily startup businesses and businesses that have collateral and assets behind them. So it's tough in the first year. There are more cash outflows than there are inflows. That's for sure. It takes a bit of time, but having the initial funds, I would say also managing that too, is quite often you'll find that founders of businesses don't take a draw from the company or don't take a salary for the company for a period of time until it's a little bit more established and the business is running a little bit more predictably or smoothly. So, there are those decisions that have to be made within the business, and it can be, the first year can be tough for sure in a startup situation. Yeah. Seed funding, I'll call bootstrapping. It would be an example of bootstrapping, getting investment from family and friends and using your own.
Thank you.
Yeah, that's it. That's a great example of how you can manage through those times. So, okay. All right, I will proceed forward with this. And Camilla, if you want to let me know if there are questions as we go, that would be great. Oh, I do see something from Jeffrey. So maybe ask Jeffrey to key in the question, and Camilla will let me know and as we go forward. Other things to consider that we haven't talked about is what happens if the client pays late. So these are,
so
I think she's cutting in and out. We might have a little bit of a disrupted connection. I'll maybe ask Camilla, we'll just hold on that question for a little bit and then we'll come back to it if that's all right. So things that you need
yes,
to,
we have one more question. Yeah. Okay.
okay, all right, I'll go for it. Things to consider. So there are things that pop up throughout the year. Not everything is predictable, and really a cash flow is an estimate. A forward-looking cash flow is simply an estimate. It will not be 100% accurate. You will make mistakes, you'll forget things, there will things that will happen that you hadn't estimated for. You may get more cash in than you planned. Maybe your sales are a little bit better. So you need to know that cash flow forecasting and planning is not an exact science. And there are things that will happen. You may have planned on a client to pay you at a certain point in time, and maybe they can't. Maybe you have an issue with collecting that. And what is that going to do to your business? So keeping those types of things in mind, because it's not so much a matter of you managing what you're paying out. It's also being able to rely on the fact that the money is going to come in when people say it is. And that's not always possible. Long-term projects can also have an impact. And I showed you a graph previously where the business had a big cash infusion at the end of the year because they finished a project. And there's more cash that comes in. Meanwhile, they've been borrowing all year long to pay out the expenses, knowing that that money is coming. Long-term projects can be a drain on the cash during the process of the project for big rewards at the end. So be very careful with that. A common thing that I see, particularly with long-term projects or with high growth, is that clients, the clients that we've had, and I'll say construction would be a great example of this, is they think growth is a wonderful, fabulous thing. And it is for a business that's prepared to grow. In a construction situation where maybe you're working on a project that's going to be a full year, you have to outlay for raw materials, for salaries, for expenses, for a variety of things over the course of that year. And maybe you don't get paid. Perhaps there's some draw payments every 3 or 4 months, but the bulk of the payment is at the end. Long-term projects can be a big drain on cash flow. And so it's really important that when you're looking at bringing on new business or high growth business, that you consider what might that do to my cash flow. Not just look at the shiny object and the result a year from now. Look at what that growth is going to do this week, next month, next quarter, and what the impact of that project is over a longer period of time. A common issue is that people look to the end result and it looks like a great idea, but how is that really going to work and feel day to day is something important to consider when you're growing and when you're looking at your cash flow estimates. Bulk purchases. Sometimes a deal can be a great thing, you know, a discount of 10 or 15% on large bulk purchases. Be careful, because it may use cash that you're going to need next week for payroll. So be very careful. Sometimes good deals are too good to be true for you. It may be a great deal, but in the long run, is it going to cause you more issues from your cash flow perspective? So make good informed decisions when it comes to bulk purchases. And is it going to work for you in all aspects and not just in terms of your costs? You know, emergencies happen. Maybe your office has some repairs. Maybe there's something that happens, whether it's an accident with a vehicle in your business, or inventory doesn't show up, plan for emergencies, or at least keep that in the back of your mind that there will be things that come up that you hadn't planned for. Seasonality of your business is a huge one. And seasonality, I'll give you a really simple example, is golf courses. All of the revenue from a golf course comes in from April to October. That's when all of the revenue and the cash flow comes in. Well, I have to tell you, they have to pay rent, they have to pay fees, they have to pay salaries in November through to March as well. So the seasonality of your business will have a big impact on when you might need to call upon a line of credit to help you through those low periods, and when you might be able to perhaps pay back loans when your cash flow is really good and strong. So keep in mind what the seasonality of your business is, and that will impact what your cash flow looks like month to month throughout the course of the year. Our little beer business that we were looking at, they're going to be very busy in the summer months in Canada, because the reality is that's when it's hot, that's when everyone's golfing, that's when socialization is a little higher. And so you're going to sell generally more product of that nature during the summer and warmer months. So seasonality of your business, as well as climate. For those of you who might not be in Canada, understanding the Canadian climate, what that does within the business community and on seasonality of businesses is really important. And you know, it's important to touch on this topic of price increases, or what I call inflation. If you're listening to the news, you're hearing it. If you're buying groceries, you're feeling it. Price increases are here. They're here to stay for a while. We're in a situation where the cost of everything is going up. The supply chain, fuel for trucks to deliver product, food, the extra wages that have to be paid in order to deliver products and services, because it's tough to find people. Those types of things you need to consider. When is the right time from a cash flow perspective, but make sure that you're passing along those costs through price increases to your clients. Those are really important things to consider and not to forget as you go through the year.
Kim, there is a question.
Okay, great.
About seasonality. Is it a good idea to change end of the year dates with Revenue Canada?
Once you establish your year-end date, just leave it. You can set your year-end date at whatever date makes sense for you. You know, it really doesn't matter what your year-end date is as it relates to your seasonality of your business, because it's really about when your cash comes in and when your cash comes out. Your year-end is your year-end. I would, you know, in terms of me, and this is what I did with my own business, I set my year-end, it's at the end of October, and I chose that time because I expected that I would be a little less busy at that point in time, and I would be able to dedicate it towards my year-end activities and my planning and those types of things. I also wanted it to line up well with my accountant, my external accountant. So, you know, just a little plug for those accountants out there and the banking partners that we have. Everyone seems to have a December 31st year end, which means every external account is doing tax returns and business types of activities, is incredibly busy from January to April, doing all of the year end work. If you want a little bit of flexibility in that, set your year end, say July through to the end of October, because that allows you to get their services at a time when they're not really crammed and not really as busy as they are in other years. There are other tax reasons to set your year end differently, depending on when you want to pay dividends and that type of thing, to give you the maximum amount of time to make those payments. I'm not a tax specialist. I would recommend that you talk to your tax accountant with regards to that. But once you set your year end, and it doesn't really matter what it is, it's fixed. And so, yeah, I wouldn't recommend you make any changes to that.
Great. Thank you. You
Okay.
can keep going.
All right. So let's get to the best practice. All right. I'm going to share with you some really quick best practices. We're about quarter to the hour now, so I'm going to go through this in a fairly quick way. Update your cash flow at a minimum weekly. And I mentioned this before. Just keep on top of it. It can get away from you if you leave it too long. So look at that bank statement every single week. And I always recommend you start with your bank statement because that's where the cash is going into, and that's where the cash is coming out of it. So if you're always looking at your bank statement and you know how much is in the bank, every day, every week, that's really, really important. I have a client, very strong business, $20 million revenue business. He said, I know how much cash I have when I come into work in the morning. I look at the bank and I know how much I have, and I know who I owe money to, and I know who owes money to me. And I do that every single day. And he has very rigid and very solid cash practices. And I recommend you do the same thing. Best practice number 2, make it really easy for your clients to pay you. If it's hard for clients to pay, then that can become a sense of you don't get the cash as quickly as you can. So if clients want to pay by credit card and you can afford the fees for a credit card, then by all means, get the cash in as quickly as you can, because once you have it, you can manage it. If it's not coming in, then it's really not an asset to you that you can use to build your business. So electronic payments, accepting credit card payments, get installment payments for large projects is also a great idea, but get the cash in as quickly as possible is really important. Deposit daily to the bank. You know, people think that should be kind of intuitive. That should be obvious. It isn't always obvious because let's face it, you're wearing, as an owner of a business, every hat within the business some days. It's a distraction to leave and go and do a deposit. So do your deposits every day if you can. And if you can make this easy on yourself by having those deposits come through electronically from your clients, that makes it one less thing for you to do. So automate the money coming in, but also make sure if you have to make deposits and checks and things like that, do it on a regular basis. Don't wait a week or two, because that's time that you could have been putting that money to use. And it can create some pinch points if you've forgotten to do the weekly deposit and the payroll is owing at the end of the week. So just stay on top of that. It's just an important practice to have in any business. Best practice number 4, plan your payments around your cash flow. And we talked about this with the monthly expenses. You know, when are your payroll taxes due? You know, when is your HST due? Making sure that if you're planning big payments, say vendors, that you can manage and have a relationship with your vendor that says, you know what, my HST and my payroll taxes are due in week 3. Is it okay if I pay you in week 1 every month? What suppliers like more than anything is the consistency of how you pay. So if you set a term and a time to pay and you meet those commitments, that will go a long way to building a strong relationship. But you can adjust terms and you can have conversations with suppliers. And I encourage you to do that and be very transparent with suppliers when it comes to when are the best weeks for you in your business to make your payments, and work with them to make that happen to your advantage when you can. Best practice number 5, create a longer term forecast. So I mentioned earlier, you know, startup companies, when investors are looking at it, your banking partners, when you're looking at that as well, they want to see 3 years. They want to see not only what was it last year, what do you think it's going to be this year, but they want you to look forward a ways. And not everyone has a crystal ball, and it won't be completely accurate. But what you will find is the more often you do your cash flow forecasting and the more timely that you keep it up to date, the more accurate it will become. You will start to learn things about your business. You'll gain insights about your business. It will help you make decisions. So as a tool, keeping it updated and looking out into the future with every little piece of information that you have is going to help you plan forward and help you get a real handle and help you grow strong cash flow. An example of this is, let's say you got a big contract, you got a big revenue stream coming in, but you've decided to give that client 60 days terms. Great that you have the revenue, but what's that going to mean to your cash flow going out further? And are you going to have to borrow or use perhaps a line of credit for that 60-day period of time to get you through the investment that you have to make in that activity? So always plan forward as far as you possibly can. And with each new piece of information, replan forward. Ask yourself, with this information that I have, do I need to change my forecast? I worked for a very long time with a large public company, and even later as the company grew and it was a very large multi-billion-dollar business, I looked at cash flow every day, and I looked at the information and determined, how does this change my forecast? Do I need to reforecast and change things going forward? And so we were always looking out forward. Big companies do this very, very well. And there's a reason they're successful, because they're future focused and they're always looking at what's ahead of them, and they're not reactionary and playing defense. So cash flow is one of those things where playing offense and getting ahead of it can really benefit you. Best practice number 6. Well, for those of you who do real cash business, just have really strong internal controls over the cash. It helps protect against theft and loss, and that can impact you financially. District 2 has access to the cash register, to the bank accounts, to the people who make the payments either by check or by EFT, those types of things. So really make sure that the people who have access to that financial asset is very restricted, and that you can trust those people. And if you can do it yourself, that's great. That's, you can trust yourself. So make sure that you restrict access to cash items, and record everything timely. That is probably the biggest control over cash, is make sure that you're counting it every day. That even sometimes if it's a high cash transaction environment, maybe you count that more than once a day, and that people that work for you know that you are inspecting and knowing what the cash amounts are. So the owner that I talked about that says he knows what his cash is in the morning when he comes to work and what it is at the end of the day, he keeps a very, very close eye on his internal controls over cash, and doesn't lose money. And a final best practice is, set a minimum target. You're going to have something happen in your business. We all do. We all have setbacks. COVID really has brought this to the forefront of the need to have emergency reserve funds. And that's not always possible for small businesses, for businesses that are just starting. But you will get to the point where you'll be in a positive position, where your growth is there, and where you have the ability to save and put money away for a rainy day. 3 to 6 months cash flow is a great reserve to have. That will get you through paying the rent for a period of time. It'll get you through paying payroll for a period of time. And what it will buy you, more importantly, is peace of mind that if you were to have something happen in your business that shuts you down for a week or two, that you can recover and that you can buy yourself some time to make good decisions on what to do next. So setting a minimum target for what you'd like your cash to be, and anything above that goes to a reserve. That's a good practice to have, is always looking at that saving type of mentality once you're in a position to be able to do that. And then let's talk about improving. I'm going to go through this very, very quickly. Make sure you're invoicing your customers quickly. Invoice your customers every day if you can. The sooner you invoice, the sooner the money comes in. Look at increasing prices when you have cost increases internally. When you're in a pinch, cut back on unnecessary expenses. Don't go to the Starbucks. Make coffee at home. That's the type of decisions that you have to make some days when you're running your own business. Encourage cash sales. Maybe you have lower terms. Maybe you can go and ask your clients to pay a little sooner, but spend the time and activity on that if you have delayed receipts. Sell your assets. I had a company that was really in it tough with cash flow. They ended up selling some property. They were able to pay off their bank loans, and it alleviated a ton of stress. And that property was just property sitting there that they were doing nothing with. So, there are ways out of cash pinches. Look at doing things more efficiently, always, because cash is king. It's so important to have that cash flow positive. If you can do things quicker, better, faster, easier, it makes such a difference within your business from a cash flow standpoint. Take a look at your lease versus buy decisions. Maybe you don't need a new vehicle. Maybe you can lease one instead of buying it. Those types of decisions on equipment can be very important from a cash flow perspective. Consider a small working capital loan for occasional low cash flow challenges that you have. We have great banking partners in Canada. We have absolutely the best banks in the world. We have lots of government resources from that perspective. So, that money is out there. It's knowing where to find it and having good relationships that will help you along the way. And then, as an owner, some days you have to make that tough decision to not take money out of the business for the benefit of the business. So, scaling and planning your growth, it's really important that you take a look at what your cash flow is from a growth perspective. It will be the single biggest area in a growth and scaling business that will require more attention than almost any other area, except for the actual growing your revenue and growing those relationships. The back office of managing your cash flow will be the area that might keep you awake at night. And if it's strong and you manage it well, it can help you sleep at night. It can make a difference in your health. Realistically, I've seen it, I've experienced it. So, keep that in mind as you're starting your journey, as you're trying to figure out how to manage things a little bit easier, a little bit better. And I'll finish it off there with 1 minute to go. Boy, oh boy, that was close.
That was close. Thanks so much, Kim. We really appreciate it. And if it's okay with you, we can answer the only question I see over the chat very quickly, and we'll let everyone go. Thanks so much for today's great session. The question is, it's over the chat. Funding for a startup is critical, and just as you have rightly highlighted, there are a few options to getting funded. Specifically, for a bank loan, will sign sell purchase contracts on the one hand, as well as channel distribution contract, prove essential elements for a startup to obtain an approval from a bank?
Absolutely. So guaranteed sales is important. If you have contracts and you have certainty in what your revenue will be, that goes a long way, particularly with startups, because with a startup, one of the biggest challenges is revenue uncertainty. The ability to sell the product is not known. You don't know when it might happen. And so when you have signed contracts and you know when the money is coming in, banking partners and partnerships that will provide you with investment like that certainty, and that can certainly help. No, great question.
Thanks so much, Kim. That's awesome. We ran out of time, but this was a great session. I'll let everyone go. Have a lovely holiday season. I will see you with more hands-on events next year. Take care. Have a good day. Bye-bye.
Thank you, everyone.